Okay, let's unpack this. For most of us, when we hear the name Kao, we think of, those household names. Bioré, face wash, Attack laundry detergent.
Maybe MOLTON BROWN if you're feeling fancy.
Right. It's
Yeah.
that globally recognized face of consumer goods right there on the shelf.
That's the familiar storefront. But the real story of Kao and why we're doing this deep dive is rooted in a much older identity. They began way back in 1887 as a simple soap business in Japan built on this concept they call Curél.
That's the key term here, Curél. It translates roughly to cleanliness and beauty, but for Kao, it's much bigger than that, isn't it?
Oh, much bigger. It means cleanliness, beauty, health, and the environment, all tied together. It's central to their whole corporate culture, which they call Curél action.
And this is all underpinned by that founder's principle, walking the right path.
Exactly. For them, that means decades of quiet, consistent growth built on trust. The belief is that if you act right, long-term sustainable success will follow. And it's genuinely a deeply rooted ethos, not just some marketing slogan they cooked up.
And that stability, it isn't just a philosophy, it's industrial. The whole thing is supported by their high-margin chemicals business.
Yes. That chemical segment is the high-performing industrial backbone. It supplies specialty ingredients, oleochemicals, functional materials, things like that, not only to outside industries, but critically back into their own consumer brands.
So it's a powerful synergy.
A very powerful competitive advantage. They control the source and the science of their own ingredients.
The ultimate competitive moat, though, the thing that really stops others from catching up, has to be their R&D. That's the engine room.
It's where they spend money. Others just won't. Their R&D investment is consistently high, often pushing 4% of sales, which is huge for fast-moving consumer goods.
And the technical differentiator is something called precision interface control technology.
Right.
What exactly does that mean in simple terms?
Think about it at the microscopic level, where two things meet the interface. How a coating sticks to a surface, how a molecule gets into the skin, or how a detergent lifts dirt from fabric. Kao specializes in precisely controlling those tiny interactions. It's how they invent whole new categories, not just compete on price in existing ones. That proprietary science is the foundation for, well, everything.
So for years, that combination culture, chemicals, R&D, it delivered exactly what you'd expect, stability. We saw Kao ride that wave, right? 4 consecutive years of record operating profit.
Mostly relying on their domestic strength and those 3 huge brands, Merries diapers, Attack detergent, and Bioré.
But that period of stable success was, well, it was masking some deeper cracks.
This is where the story gets really interesting because it sets up the radical transformation they're in right now. Despite all those record profits, their medium-term plan, K20, which ran it from 2017 to 2020, actually failed.
It missed 2 critical financial targets.
It did. The 15% operating profit margin and the 5% compounded annual sales growth rate, they missed both. And the internal conclusion was, brutally honest. The company was just too slow. Too slow on digital, too slow on structural reform.
Relying too much on momentum instead of agility.
Exactly. The success they were having was breeding complacency.
And that internal realization that they needed surgery met some intense external pressure almost immediately. It was a perfect storm, wasn't it?
A truly terrible sequence of events. Post-2021, you had the raw material price spikes, the global logistics chaos, and all that volatility in the China market. You can see the result clear as day in the 2022 numbers.
Right. The 2022 performance shock. That was a material turning point. They hit record high sales that year.
Over 1.5 trillion yen.
But operating profit dropped significantly. It fell by over 33 billion yen from the year before.
That is the sound of cost inflation just overwhelming decades of efficiency. It forced their hand. It accelerated the need for radical structural reform.
And that's what led to the K27 strategy.
Yes. They essentially ripped the whole organization up, rebuilding their consumer divisions from scratch around this mission of societal contribution, hygiene, health, and the brand new life care segment.
And crucially, management officially shifted the goalposts. They stopped chasing sales volume for sales volume's sake.
Right. They are now officially focused on maximizing return on invested capital, ROIC.
Which is a fundamental revolution in how a company like this thinks.
It is. For decades, FMCG companies lived and died by volume. Shifting to ROIC forces you to look at every product line not just as a sales generator, but as a capital consumer. If a product requires a huge factory investment and ties up inventory, but only gives a mediocre return.
It's on the chopping block, regardless of the cash it brings in.
Precisely. That metric now governs everything.
Okay, let's shift to the geographical roadmap, because the success of this reform, it really runs straight through Asia.
Asia has always been their core growth engine, expected to deliver double-digit growth.
And that's where we find one of the most surprising dynamics. The situation in China with Merries baby diapers.
Ah, yes. Merries was a flagship Japanese brand, but in 2020, demand just fell off a cliff, down a massive 20%.
20%. For a foundational product like diapers, that's huge. What
Yeah.
happened? Competition.
It was the disappearance of transfer demand. This is a bit technical, but it's essential. Transfer demand wasn't typical consumers. It was the gray market. Entrepreneurs, often called daigou.
Oh, the resellers who buy in Japan and sell at a premium in China?
Exactly. They were buying huge volumes, leveraging that made-in-Japan trust. When that arbitrage opportunity vanished, maybe due to better local brands or regulations, Kao was suddenly forced to compete purely on local demand.
A painful lesson.
Very painful lesson in globalization. They had to shift from chasing volume to focusing on high-value, differentiated products just to stay in the game.
And you can see that kind of strategic pivot in other places too, like Indonesia.
Absolutely.
Yeah.
Indonesia is crucial for their Reborn Kao project. And there, the focus isn't on luxury. It's on fundamental hygiene soap, hand wash, repellents. They're aligning their business directly with local public health needs.
While all this painful internal surgery is happening, they've gotten a powerful, if temporary, assist from something totally out of their control.
The crashing yen.
The crashing
It has
yen.
been a crucial cushion. The depreciation has been historic. The dollar went from, about 132 yen in early 2023 to nearly 156 by mid-2024.
So for a global company, that's a massive tailwind.
A huge currency tailwind. It drastically boosts the revenue and profit from overseas when you convert it back into yen. It's giving them essential breathing room to fund this difficult K27 reform.
And this all ties into their global sharp-top strategy, moving away from the old Japan-centric model.
Exactly. Products are now designed for global markets from the outset. Think of them expanding the luxury MOLTON BROWN brand aggressively into Asia's high-end hotels.
Okay, so that brings us to the core of the transformation, the K27 strategy. It seems to involve two massive, almost existential bets. The first is what they call another Kao.
This is the high-stakes pivot into the life care segment. And it is truly radical. We are talking about a consumer staple manufacturer trying to play in a highly regulated, sophisticated medical industry.
Wait, they're pivoting their core R&D, their skin and microbe science, into precision healthcare, diagnosis, and even treatment.
That's the plan.
That sounds like a moonshot. They're moving into a market dominated by pharmaceutical and biotech giants. Why?
Because they need a non-linear growth curve.
Yeah.
Incremental growth from detergent just won't cut it anymore. They're searching for massive long-term expansion, potentially aiming for a trillion-yen business in this new domain by 2030.
What's the specific tech that lets them even attempt this?
It's spearheaded by their proprietary RNA monitoring technology. This is where that precision interface science really pays off. They analyze RNA found in sebum, that's skin oil, or even in river water.
Hold on. They're analyzing skin oil to determine someone's systemic health status.
Yes.
So it's like you're reading a personalized health diary that your body writes every day.
That's a perfect analogy.
Mm-hmm.
Sebum is essentially a non-invasive window into the body's metabolic status. They can measure biomarkers that indicate stress, inflammation, pre-disease states. You name it.
Yeah.
It lets them shift from selling a generalized moisturizer to offering a personalized life value solution.
But they can't do medical diagnosis alone. They'll need partnerships, right?
Absolutely. This requires deep collaboration with pharmaceutical and medical companies. It's a huge, risky bet, but it's one that leverages their unique R&D strength.
Okay, so that's the external identity shift. The second major variable is their internal digital revolution, how they manufacture and manage their portfolio to get that higher ROIC.
That's right. The hidden logic here is abandoning the old mass production model. The traditional factory, built for high volume of identical goods, just can't handle the variety consumers demand now.
So they're pushing a digital transformation, or DX. How does that look on the ground?
The key example is their new dynamic cell production technology. So think about moving away from a long assembly line dedicated to millions of identical bottles to a modular system that can switch the product, color, and packaging in minutes.
It's like moving from offset printing to print on demand, but for a factory?
A perfect comparison. It enables efficient small lot manufacturing, which addresses consumer needs for customization while slashing inventory.
And this discipline is already showing up on the balance sheet.
It is. Portfolio management is ruthless now. They're focusing resources only on their core G11 Global and R8 Japan-centric brands and aggressively cutting SKUs, getting rid of thousands of underperforming product varieties.
And the inventory optimization has been incredible.
They achieved about a 10% reduction in inventory in Q1 2024 alone.
10% in a single quarter, that's massive. That frees up huge amounts of capital.
It does. It directly improves capital efficiency, which is the main lever driving this whole K27 reform.
Finally, let's turn to shareholder returns. For decades, Kao was the standard bearer for stable, reliable dividends in Japan.
And that tradition is still a priority. They have a public commitment to providing stable and continuous dividends. They're aiming for 36 consecutive years of increases by 2025, with a target payout ratio of a very disciplined 40%.
But the philosophy governing capital allocation has definitely changed.
Fundamentally, decisions on capex, dividends, and buybacks are all now governed by maximizing economic value added and ROIC. Capital only goes to segments that generate high returns. Share repurchases are now used strategically to enhance capital efficiency.
So what does this all mean for the immediate future? Kao's trajectory seems to hinge less on traditional sales growth and more on this difficult, self-imposed K27 surgery.
And the radical expansion of its R&D into health. They are in a critical transition period from a commodity manufacturer to a life-value solution provider.
They're trying to pull off two massive shifts at the same time, moving from mass-market production to customized precision.
And pivoting their core identity from being a reliable soap maker to a health diagnosis partner using cutting-edge RNA technology.
So the ultimate question for you, the well-informed learner, is this. Can an FMCG company, traditionally reliant on high volume and broad appeal, effectively compete and win in the highly regulated, specialized world of precision health, and still retain the core profitability needed to fund both of these radical journeys at once? That complex, high-stakes balance is what we'll be watching very closely.